Hey guys, this is Karthika Kantwal from Apex FinServe, and I'm back with a new weekend series for you guys. If you have been a long time subscriber, you will know that we have had a weekend series kind of thing, which started with, I believe, interviews, and then we had some week off coming in between for 3 weekends, after which I gave you a trading system, one built around VWAP, and then I gave you a guide on how to set your trailing stop losses or TSLs. And after some time, after a break of the weekend series due to a hectic schedule, I am back with a new weekend series based around the much talked about Elliott Wave theory or the Elliott Wave concept. Now, as with the other weekend series, if you remember the Wyckoff, if you have watched the Wyckoff series, then you know that we divided it into three parts: introduction, identification, and examples, which is exactly how we'll be doing it in this as well. This being the first part of the trio, we're going to talk about the Elliott Wave theory. What is it, and how he came up with it? Not how, rather, who came up with it. How is, to be honest, none of our business. We are just concerned with how to exploit the theory itself. We'll be discussing about, in brief, how what forms an Elliott wave, where exactly do we use it, and where exactly do we find it. Apart from that, subsequent videos will be uploaded week after week. So the next week we'll have identification, followed by examples which come from our market itself. Now, talking about Elliott wave theory or the Elliott wave principle. Before we move on to what exactly is the theory itself, talking about who came up with it. So, Elliott wave theory or the Elliott wave principle was named after Mr. Ralph Nelson Elliott, who was an American accountant and an author and a long-term market analyst as well. He was inspired by Dow and the Dow theory that was proposed, which used similar wave identification. And he noticed that not just in the market but every time in nature itself, the wave principle, or the fact that many things were fractal in nature or repetitive. Through these observations, he came up with the entire corrective impulsive wave theory, which was largely applicable in the market or on our charts, as we know. Widely considered to be one of the five greatest names in trading, this was a part of the last document as well. We have Elliott, Gann, Dow, Merrill, and Wyckoff. We have already covered Wyckoff, we are now Elliott, and hopefully we'll cover the remaining three as well. Now, this theory is based purely around price action as it was with Wyckoff, and it is very effective. However, the scale of its effectiveness is directly proportional to your understanding and implementation of it. If the theory is sound and you are able to find it and spot it on the charts, execute it with discipline, and then, well, to be honest, you'll be as good as unstoppable. However, as with humans, we all have flaws, and it's very difficult to have perfect understanding and perfect execution. It's all about practice. However, it's not as simple as slapping on an indicator based system. What I want to say here is, if you have watched my previous trading system guide considering the ATR and the VWAP based system or the moving average based system, वहाँ पे it was a clear objective based rule set where you exactly know what are your entry conditions. However, when it comes to these price action backed concepts or price action backed theories, it's all about the chart time that you put in, which would allow you to identify the optimal conditions to take an entry, the optimal RR, and so on, so that you can tweak everything as per your comfort level. So give it time. If you have patience, if you are willing to put in the work, this is a really strong and solid concept. One thing I would like to recommend is, if you have not watched the Wyckoff theory before this, or at least until now, go ahead and watch that, because that would allow you to understand this a lot easier, because it does cover some small aspects of the Elliott wave understanding. However, if you do not have the time and you are too busy to dedicate an hour to learning Wyckoff, then you can simply check out the phase analysis as well, which is a simple 15 to 20 minutes video that I uploaded back when the channel was new. I'll share the links of both these playlists in the section below, or in the about section below, so you can check it out from there. I'll also add down these links at the end of the video, so if you want to take it from there, you can directly skip to the end. Now, talking about the Elliott wave system or the Elliott wave theory, it is based around some basic principles. Now, what it is trying to do here essentially is, Elliott wave theory measures investor psychology through repetitive patterns in price. Similarly, we have a similar understanding through phase analysis too, that whenever we have a bullish trend, we have a high low formation, bearish is low low lower high, and these formations are repetitive, and you need to have these fundamental structural formations in order for a trend to be established. We have something like that here as well. However, here it's given in a lot more depth and detail. The second is that it's built around three straight points. First is that human nature is repetitive and predictive, which means that we tend to do some things the same in the same manner again and again, and if you are observing keenly enough, you can definitely find a predictive manner to it. Second is that the path of prices is not a product on news. Now this does take into assumption that all the movement that comes in your candlestick chart, all the movement that you see on your chart in front of your screen, it all comes naturally through trader driven demand and supply, and not through news or information that is not being factored in, or materialistic information. The third one is market unfolds in waves in any given direction. What he's trying to say here is, if the market is bullish, it won't just go up, up and up. It has to have waves where it's climbing and then falling a bit, climbing and then falling a bit. If it's downwards, similarly, it has to happen in waves as well. Now, one very important thing, or one very important part of the Elliott Wave theory is the Fibonacci series, which is the Fibonacci retracement and the Fibonacci extension theory. That also I have covered in detail how to use the Fibonacci tool. So if you are unaware of that, if you are unaware of what exactly the Fibonacci tool stands for, I would advise that you check out that video as well. If you need the link for that video, let me know in the comment section below and I'll share it with you. If you don't need it, well, good for you. Now the last one says that the movement in the direction of the trend is always unfolding in 5 waves called motive waves or impulse waves, whereas the correction against the trend is in 3 waves called corrective waves. However, simplifying it, instead of calling them motive waves and corrective waves, we have a simpler bifurcation, which is through mono waves and poly waves. Now, a mono wave is a simple one swing leg, as you may call it, in the higher high, higher low formation. It can be one higher high, one higher low, or the next higher high. Just one swing leg is known as a mono wave. However, if you consider the entire structure, which can be a combination of multiple mono waves, it is identified as a poly wave. Now, a mono wave always forms, or it always acts as a building block for all wave-based theories. It can be the Dow, Elliott, or the phase analysis theory. Grouping of mono waves is called a poly wave, which is what we are looking for when we talk about Elliott waves. Mono waves are good, but in and by itself, they don't really add value to your analysis, in the sense that just one swing leg won't give you any understanding of the entire underlying trend. But if you look at the entire structure, you'll have a far better understanding of the trend, of the strength, of the duration, and so on. Now, Elliott waves or the Elliott wave theory is banking on 2 waves. If we go into proper Elliott wave theory by the textbooks, it is made up of 2 wave types: a 5-part impulse or motive wave and a 3-part corrective wave. An impulse or motive wave is one that moves in the direction of the trend. In an uptrend, you have an impulse move that's going to be largely bullish. In a downtrend, you'll have an impulse move that is largely bearish or aiming downwards. A corrective wave, as the name suggests, moves against the direction of the primary trend. As you can see in the given examples below on the screen, on the left hand side you have your impulsive pattern, the 5-wave impulsive pattern. First is your first mono wave, second, third, fourth, again correction, and then fifth again impulsive. After that you have a corrective pattern A, B, and C. However, one key concept when we talk about Elliott waves is that these concepts are fractal in nature, which means that when I talk about a corrective pattern, that corrective pattern itself can be a part of the wave 1 to 2, which means that we might have a ABC formation within 1 and 2 itself, and we might have a 1 to 5 formation in the 0 to 1 swing leg or the 2 to 3 swing leg. To better understand this, we have a complete illustration attached in the PDF. As you can see, this is how a general complete Elliott wave looks like. You have the entire 0 to 1, 1 to 2, 3, 4, 5, followed by ABC correction. However, as you can note, there are multiple subwaves always as well, which does prove that it is fractal in nature. If you observe the first 0 to 1, that in itself has a 1 2 3 4 5 wave layout, followed by ABC wave in the corrective 1 to 2 swing leg. Now there are waves, there are wave conditions which have to be met before you classify each wave as corrective wave or impulsive wave. The conditions we'll be discussing in much detail in the next identification video. Because this is just an introductory video to the theory of Elliott waves, we will not be dwelling down into the Fibonacci conditions that are much needed or required to be met for you to declare any wave movement as a corrective wave or an impulsive wave. Now, describing these two waves in a bit more detail so that you understand what exactly happens within the market itself when the prices is making a impulsive wave or a 5-wave impulse wave or a 3-wave corrective wave. Talking first about the impulse leg or the impulse wave or 5-part initiation part of the Elliott wave. What is it? Now, it consists of 5 waves of whom 1, 3 and 5 are moving in the same direction in increasing degree, as was illustrated in the example above. Then you have 2 and 4 which are corrective waves in the opposite direction. Now, because they are fractal in nature, you can have an impulsive wave within the first leg, the third leg or the fifth leg itself, and you can have an ABC corrective wave in the second and fourth wave too. Now, describing briefly what exactly is the public sentiment or the market participant sentiment or the general market sentiment in each of these swing legs. Talking about the first leg, which is the first wave. Now, what happens here is when the first wave of a new bull market begins, the entire market anticipation is generally negative. The previous trend is still considered to be strongly in force. Now, this can be a lower high pullback part of the underlying structure. The analysts continue to revise their earning estimates lower and the economy probably does not look strong, which indicates that to be honest, there is no reason to buy at this point, which is also the reason why the first leg is considered to be the most difficult to identify. Now, sentiment surveys are decidedly bearish where everybody thinks that the prices are going to tank, put options are in vogue and the IV in the option market is high. Volume might increase a bit as the prices rise, but definitely not enough for any technical analyst to think that okay, I might initiate or I might want to initiate new longs at this point of time. Then we move on to the wave 2. If you are comfortable with phase analysis, you might understand that if it is making lower highs and let's say it has made a decent lower high which is closer to the previous swing high, after that it does need to break the previous swing low. Only then the running lower high structure is considered valid, otherwise it is invalidated. What happens here is in the second wave, which acts as a corrective wave for the first one, the prices do come down, the prices do correct. However, they never extend below the starting point of wave 1, or in short, they never actually break the previous swing low. Typically, the news is still bad, the buying sentiment is still quite low. As the prices try to retest the prior low, the bearish sentiment quickly builds and the crowd unapologetically reminds that all the bearish market sentiments, all the bears are still deeply engraved and are still going to push the prices down. However, the positivity is now starting to reflect in the market. Some positive signs appear. It can be through the heavyweights of the index giving positive results, or the economy in general slightly recovering. One condition here, or one very obvious condition here, is that volume should be lower during wave 2 than during wave 1, which means that the sellers are much less in number than the people who actually bought in wave 1, which indicates that the people who bought in wave 1, or at least half or more of them, are still holding on to their longs and are simply not exiting. Then we move on to the third leg, which is usually the largest and the most powerful wave in a trend when we talk about forex and equity markets. However, it has been noted that in commodity markets, wave 5 is the largest. I have not personally verified that, but it is said in many books. Now, the news still in wave 3 is gradually turning out to be positive. The economy is recovering and the fundamental analysts are now getting on track with the bullish mindset as well, because it doesn't matter how new you are to the markets, a high low formation is pretty easy to spot, and at this point that is exactly what you can see, because the price has broken the previous swing high. And what is happening here is many people who had shorted above, with the stop loss being placed above the swing high of the first wave. These SLs are being taken out as well, resulting in increased buying pressure. Now the prices here rise quickly, corrections are short-lived and shallow. Anyone looking to get in on a pullback is highly likely to miss the boat. The wave 3 is the largest and the most impulsive wave of all the 1 to 5 mono waves. Now that is the reason, that is the reason why many people they take trades without planning. As soon as they spot the swing high of the first wave being broken, they don't wait for proper confirmation, they just jump in. Most market players remain negative, but by wave 3's midpoint the crowd will often join the bullish trend. However, as with any buying or selling pressure, it cannot continuously go on and on. Once the buying pressure on wave 3 subsides, we move on to the fourth, which is the corrective wave number 4. I told you guys 1, 3 and 5 are impulsive, 2 and 4 are corrective waves. Moving on to wave 4. Wave 4 corrects wave 3. However, one very big condition is that the volume on wave 4 must be well lower than the volume that was there in wave 3. The reason being the same, which indicates that the people who bought in wave 3 are holding on and not exiting again and again. Now this is generally viewed as a good place for new entries if you are well versed with the Elliott Wave theory and you are able to plot out the extent of the next incoming wave 5. Then you have the final swing leg, which is the wave 5. Now wave 5 is the final leg in the direction of the dominant trend or in the direction of the first and the third wave. The news is almost universally positive and everyone is bullish. Unfortunately, this is when many average investors or small time participants finally buy in right before the top. Now, if you are familiar with the Wyckoff theory, you know the composite man, you know that the composite man bought his longs in wave 1 and wave 3, and in wave 5 will now sell off his longs to new participants who want to buy more and more, small time retail participants. That is the reason why in wave 5 the volume is going to be often lower than in wave 3, and you will also start noticing many momentum indicators and oscillators starting to show bearish divergence, which is the price making higher highs and the indicator making lower highs. Now this wave 5 is generally viewed as an exit point for those who took longs in wave 3, wave 1 or even in wave 4. The wave 5 lacks huge enthusiasm and the strength which was found in the wave 3 rally. It is caused by a small group of retail traders who still want to buy and buy again and again. Although the prices do end up making a new high above wave 3, the rate of power or strength inside wave 5 is very small when compared to the wave 3 advance. That is why no new initiations or no new trades or no new positions are generally recommended to be taken when you have spotted wave 5 or when the wave 5 has already begun. That is it for the impulse wave. Now moving on to the corrective wave theory. I told you guys corrective waves are in the opposite direction of the trend, as the name suggests. Now a corrective wave is a 3-wave path, A, B and C. Now an impulsive wave is always followed by a corrective pattern. Corrective waves tend to be more complex and time consuming than the impulse waves. That is why corrective waves are not generally viewed as aggressive entry points, but rather we wait for the corrective pattern to be completed and then the next leg of the impulse wave to start, so that you can actually take an entry there. Corrective waves or correction waves, they only become obvious when they are near completion, which is a very big drawback. However, they are made of 3 waves, which is wave A, B and C. Now in the wave A of bear market, considering the same example of a bullish impulse wave where the corrective waves are bearish, in the wave A the fundamental news is usually still positive. The people are still trying to buy in more and more. Let's say you had wave 1 beginning where the news started slightly being positive, and then you had corrective, which is 1 to 2, where people are still buying because they are anticipating that the previous swing high has been broken and the price is going to make higher high, higher lows. If you want to consider an even better example, let's talk about the wave 3 ending, where the news has already turned positive. The people are still buying. Most analysts see the drop as a correction in a still active bull market. Some technical indicators that accompany wave A include increased volume, rising implied volatility in the option market, and possibly higher open interest in the related futures market. Then you have the second wave, which is wave B. Here, somebody who is well versed with Elliott Wave, or if not Elliott Wave, a simple theory as phase analysis, can be started to can start to be wary of what exactly is the structure that's going to be formed, because instead of making higher highs, the price is now made a lower high, which is a signal of reducing buying pressure. The prices reverse higher, which many see as a resumption of the now gone bull market. Those familiar with classical technical analysis may see the peak as a right shoulder of an HNS reversal pattern. Now this is a very textbook example. It's not necessary that this is a scenario that happens each and every time. Now volume again comes into play. It says that the volume during wave B should be lower than the volume in wave A, which means that the people are buying, but the buying pressure is shallow and not as much as the people wanting to sell. By this point, the fundamentals are probably no longer improving. They are stagnant, but they most likely have not yet turned negative. They will turn negative in the price in the wave C. Prices move impulsively lower in 5 waves. You can have a 1 to 5 mini formation within the wave C as well. The volume starts picking up, and by the third leg of wave C, almost everyone realizes that a bear market is firmly running. Wave C has to be at least as large as wave A. Now, what I told you here is a very textbook introduction of what exactly is the Elliott wave theory, what exactly comprises of the impulse wave and the corrective waves. What we'll be discussing next time is the keen details within these corrective waves, the degree of the waves, the relation between Fibonacci series, Fibonacci extension, retracement, as well as the placement of the waves, what is the best time frame, what are the best charts, so on and so forth. One thing to note when we talk about corrective waves here is that the textbook definition of corrective waves is that they move against the trend of the greater degree running. However, corrective waves have a lot more variety in the sense that they have diagonal, flat and triangular. We have not discussed that yet. We will pick it up next time. Sometimes it can be rather difficult to identify corrective patterns until they are completed. However, both trend and counter trend can unfold in corrective pattern in today's market. Corrective waves are probably better defined as waves that move in 3 but never in 5. Only impulse or motive waves are 5 paired mono waves or a 5 poly wave. Corrective waves can never be more than 3, which is ABC. Now, as I said, this was a brief introduction to the Elliott wave concept, to the Elliott wave theory. If you think that this is a bit too technical for you to handle, you might want to check out the Wyckoff theory, the phase analysis and the Fibonacci retracement before I upload the next series, or which is next part of this series, which is the next weekend, so that you are brushed up on the knowledge, because next week we'll be diving into proper technical you can say a rule set of what exactly defines an Elliott wave in mathematical terms, the time frames, the chart examples and so on, after which you should be able to find the basic Elliott wave counts or the basic Elliott wave charts by yourself. Now this marks the end of the first part of this video, guys, of the first part of this video series. Let me know if you like it in the comment section below. It has been a long time, but I do hope that you still appreciate it. I hope that you have been wanting the Elliott wave series, and at last it's here. Thank you so much for watching, guys. I'll be back tomorrow with your daily market analysis in the evening as usual. If you like such content, if you want us to keep posting, don't forget to like the video, comment for the YouTube algorithm, subscribe to the channel, press that bell notification icon as well. Thank you so much for watching. I hope you are having a wonderful weekend. Have a good night. Bye.